All right, welcome to another Forex session. In this session, I want to introduce us to what we call fake out. Fake outs is something that you see every time in the market. You see it every time in the market. Sometimes it's being caused by manipulation by some big traders, okay, just to cause liquidity in the market. But it's something that you must see daily in the market so that you don't get confused or it does not take you unaware. And I also show us how to overcome fake out. Okay. Now, if you check, the market move from this point, broke this structure, return back to retest this structure. Now, if you notice this level, there was no fake out. The market just respected the structure and move on like that. There was no fake out. You get it? There was no fake out. Now the market came, broke this structure at the upside and did as if it want to continue to the upside. And the market came back. Yes, it still continued the movement, but so many persons have already bought at this level. They have already entered a buy trade at this level because of the breakout. So many traders that trade whenever they see break and retest, they just enter into a trade. This market will stop them out if their stop is very tight and the market continues going to the direction that they were hoping it to go to. That is why I really don't advise putting your stop loss so tight. If I want to trade this, my stop loss will be somewhere around here. Yeah. If I want to swing, this is where my stop will be. If I want to swing, my stop will be at this level. Yeah. If let's assume I'm trading from this point. My stop will be at this level. I always give space for market movement. I give space for the market to do whatever the market wants to do. Okay. Now, why I don't really advise putting your stop so tight is because of something like this. Yes, sometimes it can just break and continue to the downside. Yeah, it happens. Okay, it happens. That is why if you are using a wide stop, you should try and reduce your lot so that you still be risking the same amount you will be risking if your stop is tight. Okay, when we go into risk management, I think one of these days we're going to go into risk management. I think this is about 6 courses on a row. So I believe the 4th course will be on risk management, and that should be next week. We'll do a course on risk management. You understand how to reduce your lot size if you are using a wide stop, but it's much safer to use a wide stop and reduce your loss size so that you will still be risking the same amount, but you will give room for the market to do its thing. Yes, this type of trading might actually require much patience, but it is actually more profitable because you are at rest. You are not put under tension because the market is coming close to your stop loss. No. Okay. So now, so many traders must have already started triggering their trade from this point. The market came and stopped them out and continue going to the upside. Now, if I saw this market, I wouldn't have entered. This is when I would have entered the market. Let me show you. I would have drawn like this. Now, when the market was here, I wouldn't have entered the trade because of this resistance. vertical resistance that is forming at the top. Now, somebody might say, what about when this bullish candle formed? At least is a good signal to enter into the market. Yes, it's a good signal to enter into the market, but this retracement was not deep. It was not deep. That will bring me to saying this: always wait for deep retracement. When I mean deep retracement, I don't want to start talking about Fibonacci. I am not really the indicator kind of trader. I just believe that your candlestick and support and resistance and chart patterns and other stuff can actually give you what you need in the market. Now, if you check when this market broke out, when the market broke out from this level, you saw the retracement. The retracement was deep. All this was retracement. All this was retracement. So it was a deep retracement, and that is why the market moved. Now, why I wouldn't have entered a buy trade there is because this retracement is not deep. I normally call it that I like the market taking a deep breath. That deep breath is like retracing down, so that when it breathes out, it will have enough pressure, enough momentum to continue. So when the market did not take a deep breath, I don't enter into the market. So these are some measures I put in place so that I don't just jump into the market. Now, that is why I wouldn't have entered a trade here, even though the structure have been broken. I wouldn't have entered a trade because the market have not done a deep retracement. But you can see what the market did a deep retracement down. Now, I wouldn't have also be buying here because, as you can see, this is a lot of bearish momentum. So I wouldn't have also sold here. But immediately this market break through this resistance, this vertical resistance, this is a good place to do what? To trigger your trade. Because one, this structure have been broken and there's a big candlestick. Before you enter a trade, always make sure that the candlestick that break the structure is a big one. It should be a candlestick with volume. Okay, if it's a small candlestick that break through a structure, there's every possibility that the market will still retrace back because that is not enough momentum. Now look at what happened. The market has taken a deep breath. Then look at the big engulfing candle breaking through this structure. So this is a good place to do what? To trigger your trade. Now, if I enter a trade here, my stop loss will be around here also. Though you can put your stop loss, and this is also a very good place to put your stop. But this is where I will still put my stop at this point. And I will target 1:1, 1:1.5, 1:2. You get it? So now somebody might say, okay, look at what the market did. The market broke this structure, but it did not do a deep retracement. He didn't do a deep retracement. So I wouldn't have entered a trade here. Now, let me tell you the truth. I wouldn't have taken this trade. Yes, I wouldn't have taken this trade because the market did not take a deep retracement. I wouldn't have taken this trade. And if you check, let me check. Look at what the market did. For you to know that this is look at what the market did. The market did not move that much. It did not move that much compared to this particular point where the market took a deep breath and moved forward. Now, in this place, the market did not even take a deep breath downward or did any retracement. It just broke and started going. And look at what happened. The market started coming back. Now, if I've taken this trade, let's say if I put my stop loss around here, and this is not even up to 1:1. It's not up to 1:1. So it's not a good trade to have been taken by me. Okay, that is why always wait for the market to do a deep retracement. Now, if you see what the market is doing, the market is not taking that retracement. See what the market is doing? Now, I can call this that it's already doing a deep retracement. I just wanted to understand what I mean by deep retracement. Taking a deep breath, not just breaking a structure and the market just keep going. And let's say before I can join this trade, now it's taking a deep retracement, which is good. Now what I will do, the market is coming back to this zone. It's coming back to this zone. Okay. Market is coming back to this zone. Now, do you know what I would do? I'll wait the market somewhere around here to break this upper trend line, or when I say vertical resistance. Now, the market is taking a deep breath. Now, once the market, this is the only time I can actually enter this trade. If the market break, now it has taken a deep breath, meaning it has retraced. Now, if I see a big bullish candle similar to this one, at least the same size, then I can enter a trade at that candle. Then my stop loss will still be below this structure. My stop loss will be somewhere around here. And I will target 1:1.5, 1:2. So now, in summary, what am I trying to say? When a structure is broken, always wait for the market to retrace, to do a proper retracement, which is retracing not just one candlestick retracement. Yes, sometimes one candlestick retracement can be very, very good, but it is safer when the market do a good retracement, giving you lower high, higher low, just like that, just giving you those structural movements, just like that, no matter whether up or down trend, just is giving you that retracement back. Then you draw your trend line and wait for the market to break and retest it. Now, when the market is retracing, many a times it always forms a pattern. It can be a flag, it can be a wedge pattern, it can be any of the patterns, but just wait for that pattern to break and retest. Then you cannot join the market. Okay, so that is it for trading, break and retest, and also understanding fake out. I told us about fake out. Fake out always happen in the market, but if you can be patient enough to wait for structure to break, you will be able to overcome fake out, or at least you reduce the number of times you'll be stopped out by fake out. Okay, all right, we end this class here. So just do your practice and spend time on the chat. If you have any question, you can send it to my mail. I'll see you at the next lecture.